Good morning, everybody. This is Eric Daly from Miller Johnson. Thank you for joining us for this morning's COVID-19 coronavirus Miller Johnson Response Team webinar, which today will focus on a roundup of Paycheck Protection Program related developments over the course of the last week and especially over the course of the last day. Before we jump into that, we always like to start our daily webinars with just a brief overview of recent developments in general related to COVID-19, as well as, importantly from my perspective, just a reminder of our sort of core principles and how Miller Johnson is approaching this situation, which is to focus on collaboration with clients and to kind of double down on our principles relating to valuing intellect and candor, ingenuity as we work with clients and other community partners through this very difficult health crisis and economic crisis at the same time. So having said that, some of the kind of broader news providing context for today's more specific presentation is that the statistics relating to new confirmed cases of coronavirus and new deaths here in the U.S. and in Michigan, while those numbers continue to reflect a flattening of the curve in many places, continues to be sort of a regional evaluation relating to where the hot spots are, if you will. So while the confirmed deaths related to COVID-19 in the U.S. Now exceed 100,000, there seem to be many areas of the country where that trend is leveling off, but there are other new hotspots, places like Wisconsin, Alabama, California, that have seen, I don't know if we want to call it a second wave yet, but they've seen sort of a new increase in the number of cases, at least. And there's a similar trend playing out more globally, where some countries that maybe didn't see or report as many cases initially, like Russia, Brazil, Argentina, and some other locations, have now started to experience or report their experience of having more cases and deaths related to that, unfortunately. Apart from that, here in the United States, the CDC has released some new, pretty far-reaching guidelines, which will be relevant as offices and businesses start reopening and going back to work. The recommendations really run the gamut from kind of technical advice on ventilation systems to getting rid of snack bins and coffee makers, things like that. So I'm sure we'll have more from our employment section and others within Miller Johnson to say about those new guidelines in the days and week ahead. And then lastly, before we get into today's specific topic on PPP, and it, I guess, is a good segue into the topic of the PPP. Over 40 million Americans have now filed for unemployment during the COVID-19 pandemic period, and the official unemployment rate is right around 24%. And the kind of reasons for that, some of which are obvious, others more subtle or kind of beyond the scope of this presentation, but it does relate to the Paycheck Protection Program, which is meant to provide a mechanism for at least small businesses to keep their employees on payroll so that they are not in the scope of those unemployment figures. So with all that having been said, why don't we continue on with the presentation? And I'm embarrassed to say I didn't already introduce Amy Murphy, who is a litigation partner of mine at Miller Johnson and is part of our cross-functional Paycheck Protection Program compliance and audit preparedness program team and working group that is making sure that we evaluate and understand all the aspects of the PPP, not only from the perspective of kind of a transactional attorney, such as my background would provide, but also from the perspective of kind of longer term, making sure that you've got the right compliance protocols in place and being prepared for any issues that could come up if a loan were reviewed or audited and the SBA or another enforcement body raised any issues. So thank you, Amy, for joining us. So anything else, Amy, that you'd like to say at the outset?
No, just thank you. Thanks, Eric, for the intro, and I'm happy to be here listening to Eric give a really nice roundup of some of the updates that occurred in the past week or so. There's been some pretty major, developments that I think will be of interest to our listeners this morning. So happy Friday, and I'll chime in from time to time with my questions or thoughts on kind of audit readiness ideas.
Great. Thank you very much, Amy. Appreciate that. So here's a quick overview of what we'll cover today. The topic of most interest will be this first one, the Payroll Protection Program Flexibility Act. We'll discuss that first. And then an announcement yesterday by SBA and Treasury about dedicating $10 billion in funds for loan origination by CDFIs. We'll talk about 2 interim final rules that were released last Friday, late in the day last Friday, as we were headed into the holiday weekend. Some concluding remarks, Q&A, and then Amy will just briefly summarize and provide some insight into our firm's audit and compliance preparedness program. So with that said, why don't we jump into it, because there's a lot to cover. Okay, so the Payroll Protection Program Flexibility Act, there's a lot of, I think, acronyms that will start proliferating again here. So the PPPFA, the bipartisan bill passed yesterday by the House of Representatives. The final vote in the House was 417 in favor and only 1 opposed. So this is truly rare in not only the COVID-19 era, but just in general, right, in current politics, is to have this kind of one-sidedness and bipartisan support for a bill. Basically this bill, which was also co-sponsored on a bipartisan basis by a Republican and a Democrat, is designed to give PPP borrowers, both current borrowers and potentially future borrowers who aren't in the program yet, more time and flexibility in how they spend their loan proceeds and make staffing or restaffing decisions going forward. The Senate does seem inclined to approve something similar. In fact, they have a kind of parallel bill that was introduced last week. They were hoping to vote on it before the Memorial Day weekend. The Senate leadership seemed hopeful to vote on it. It did not end up happening before they recessed. Much of which is similar. I'll note a few of the differences as we go through the PPPFA here. But because of those differences, there may be some, I think there's a working assumption that the Senate will approve either the House bill as written or a very similar bill. But if it's similar and not the same, there may be some reconciliation necessary between the 2 bills. but hopefully not a lot. So let's go to the next slide, please. So here are key proposed changes. I underline the word proposed here because this is not the law yet. This has just been passed by the House, and as I just mentioned, the Senate would need to either approve this bill or a similar bill, go through reconciliation, ultimately get it signed by the president. So for right now, these are all potential or proposed changes to the PPP, but it seems likely that some version or flavor of these changes will soon be approved by Congress and likely signed into law. The major ones that it will be of interest to PPP borrowers are outlined here. So extending the 8-week loan forgiveness period to 24 weeks or December 31st, 2020, whichever comes first, would obviously be very significant change and allow borrowers more time to use funds on a forgivable basis, especially those like restaurants, other service businesses that have not been able to remain open during or be open at anything close to full capacity during that first 8-week period, which is coming to a close soon for many of the earlier borrowers in the PPP. So this would give them more time to spend the funds on a forgivable basis. The other significant change is reducing the minimum amount that must be spent on payroll costs from 75% of the loan to 60%. And this is one of the areas where the House and Senate bills differ. The Senate bill would not change the 75% payroll cost requirement. And I know Senator Rubio, who's been very involved in shepherding this program through the Senate anyway, has said that the language in the House bill that reduces the threshold to 60% has some technical issues that may create more uncertainty for borrowers just because of the way it's drafted. And I think that's right. The language is a little bit ambiguous. So if it's passed kind of as written, I think Treasury will need to interpret that through rulemaking or FAQs. But this may be one of the areas where there's substantive reconciliation, both kind of around what the right percentage is for payroll costs, but also kind of what the language says about whether this, how this threshold works in relation to forgiveness, if it's an all or nothing approach versus, more of a proration where you lose some percentage of your forgiveness if you don't get to, say, the 60% threshold that's being proposed. So that's a little wonky, but that may be one of the things that holds up the bill a little bit from ultimately being passed by Congress. Another major change is, in general, anywhere where there's a June 30th date in the original PPP language of the CARES Act, that's being extended out to December 31st as a general matter. So June 30th was the deadline, or currently still is the deadline for obtaining a PPP loan. That would be extended to December 31st, as would the safe harbor date for rehiring and restoring compensation levels to the pre-COVID-19 hiring or staffing levels and compensation levels. That would also be extended to December 31st, 2020. Other changes would include a longer deferral period. So I think right now it's 6 months of deferred interest and principal payments on any unforgiven portion of the loan. That would be extended out until whenever the lender receives its forgiveness payment. So you wouldn't have a situation where the borrower is making payments on the loan even though there's been no forgiveness determination yet. That would be addressed by the House legislation. And then the repayment period for loans would also be extended as to new loans. So only as to new PPP loans, the maturity would be extended from 2 years to a minimum of 5 years. There may be a procedure there for lenders and borrowers to mutually agree to extend their existing loans maturity from 2 years to 5 years. And that does seem to be contemplated by the bill that passed the House, but it's unclear kind of how many banks would want to do that, just in terms of, you know, the amount of additional administrative work it would create, basically to amend all the notes that have been put in place for current PPP borrowers that have a 2-year term. But we'll see, I guess, if this passes and there is some ability to do that, you know, how much borrower pressure there would be, given that hopefully more borrowers would qualify for full forgiveness and kind of make the maximum repayment period more of an academic issue. And then very importantly, the House proposed bill would allow PPP participants to utilize the CARES Act provisions that allow payroll tax deferral into the next 2 years. If you've been following the PPP, you'll probably remember that for those borrowers who have a portion of their loan forgiven, they become ineligible for this payroll tax deferral provision under the CARES Act. So this would reverse that. Next slide, please. Okay, so as I mentioned on the earlier slide, you know, subject to continued fund availability under the House bill, the loans would be available through December 31st of this year instead of June 30th. And here's another area, the second set of bullet points about new exceptions for decreases in full-time equivalent employees. This is another area where there seems to be a substantive difference between the House bill and what the Senate wants to do. The House bill provides that if a borrower is unable to increase their FTE count, or if they have a decline in their full-time equivalent employees as a result of the following reasons, those decreases would not count against the loan forgiveness calculations or reductions. And the new buckets are, and this doesn't change the existing framework, it just adds new exceptions. So the new exceptions would be if a borrower is unable to rehire an employee that was employed as of February 15th, 2020, or a similarly qualified employee for that unfilled position. So an example of that might be somebody has been laid off, finds other work, you as a borrower attempt to rehire them, but they're already working for somebody else, and you just can't find, maybe they're a highly technical person, you can't find a similarly qualified employee to fill that position by December 31st of this year. That would be the type of scenario that fits into that first exception, I think. And then the other one, which is probably more likely to be relevant, I think, is and more open-ended, is any inability to rehire back up to prior levels resulting from basically safety requirements and compliance issues from Health and Human Services, Center for Disease Control, or OSHA, that have been put into effect after March 1st. So, you know, we started off in the news roundup talking about the CDC guidance that's been put out there relating to snacks and office ventilation and the like. Well, if there are any of those sorts of things that create social distancing requirements, sanitation requirements, for example, is included in the legislation that make it, not feasible to, just have the same number of employees in the same space, for example, then that would, the legislation would not penalize you for that. Basically, it wouldn't put you in the position of saying, okay, I'm going to hire back all the people, even though it would be unsafe to have them working in the conditions that the CDC, for example, is recommending against. So that is a substantive difference potentially with the Senate. Senator Rubio, again, has identified these exceptions as potentially creating a disincentive to rehire workers, which, was the original impetus of the PPP, was really to keep workers on payroll. So there may be some reconciliation around those points ultimately. Next slide, please. And then one last proposed change to touch on here. If the borrower, so the original CARES Act PPP language said nothing about, kind of when a borrower needs to apply for forgiveness. And the amendment proposed by the House bill still doesn't put a hard deadline on a borrower applying for forgiveness, but it would say that if a borrower has not applied for loan forgiveness within 10 months after their forgiveness period concludes, then that borrower would need to begin making principal and interest payments on their loan. So they can't just kind of leave the loan in limbo indefinitely if they don't apply for forgiveness. So it would sort of put an implicit deadline of 10 months after the end of the forgiveness period on going into, and probably earlier than that, to seek loan forgiveness. So before we move on from the House legislation, I did want to, the House bill, I did want to mention a few things that it does not address or modify in the PPP. Probably most importantly, there's no expansion or conversely no contraction in eligibility criteria to participate in the PPP. There have been some speculation or reporting about maybe opening up to 501c6 organizations with like chambers of commerce. That is not included in the House bill anyway. We'll see if the Senate does anything on that front. But right now, basically, the threshold issues of am I eligible to participate in the PPP remain the same. And along those lines, there's been no, the House bill does not change anything related to the required certifications, including the need certification, which has, been discussed quite a lot by borrowers, lenders, and Miller Johnson attorneys on our webinars. So that remains sort of an opaque consideration. The maximum loan calculation, so even though the forgiveness period would be extended to potentially up to 24 weeks, the maximum loan amount that a borrower would be eligible for would remain the same. So you as a PPP borrower would have the same amount of funds potentially to use, but over a longer period. So it doesn't increase the amount of any loan that a borrower would be eligible for, nor does it expand the House bill does not expand the potential forgivable uses of PPP loans. It doesn't increase appropriations for PPP loans because there's still well over $100 billion in the quote-unquote round 2 PPP funding available, and it doesn't change the 1% interest rate that applies to any unforgiven portion of a PPP loan. One thing before we move on the forgivable uses of PPP loans, that could be another area where there's a difference between the Senate bill and the House bill. creating more flexibility for PPP borrowers. The Senate bill would allow, as a new forgivable category of uses, things like personal protective equipment or workplace safety modification expenses. So that may ultimately be something that ends up being on the table if there is a reconciliation and not just a passage of the House bill as is. Next slide, please. So in terms of next steps for this piece of legislation, if it's passed by the Senate or reconciled with other Senate legislation and then signed by the President, which seems likely in some version or flavor of what's been passed by the House at this point, then the SBA and Treasury would need to go back. I mean, all the existing application forms, FAQs, guidance, IFRs, maybe not all, maybe that's overstating it, but virtually all reference many of the limitations and terms that are modified or that would be modified by the new legislation. So there would be a large undertaking by SBA and Treasury to go back and revisit all the guidance that's been issued. One would hope that only changes kind of along the lines that Congress is explicitly or Congress ultimately explicitly makes as part of any legislation would be incorporated into the updated forms and guidance, but I suppose it would give the SBA and Treasury an opportunity to kind of revisit yet again some of the guidance which has already been, moving target, obviously, for those who've been following these issues. And then, another thing I think that will come up, and this may be part of what Treasury needs to look at and SBA needs to look at when they're revisiting the regulations and guidances. What do you do about an initial borrower who obtained their PPP loan very early in April after the program went live and, use the funds assuming they would only have that 8-week period to do so on a forgivable basis? An easy situation to think about in an understandably aggrieved borrower would be one that got the loan, wasn't able to reopen because of their industry, circumstances evolved, and they're just not able to reopen during that 8-week period. But because they'd only be able to get the loan forgiven if they spent 75% of it on payroll costs, they went ahead and did that. Well, now it turns out they could have had the loans for 24 weeks and waited until they were able to bring their employees back. It's going to create some friction on that front. And so I think as a political matter and as a kind of a regulatory matter, there's going to be either a lot of upset borrowers or some need to address that in the guidance. And I don't know what that might look like. I'd be speculating. So we'll see if that evolves as something that works its way into the process of congressionally approved changes to the PPP. So,
hey, Eric, before we move on, I'm curious, given how much you know about the program and, the probably countless calls you've fielded on these issues that are evolving, what do you consider big picture, the good news in this act, assuming some version like it gets passed and becomes law?
Yeah, thanks, Amy. I mean, I would say for those borrowers who haven't already spent their PPP loan proceeds to pay, workers, say the understandably aggrieved borrowers under this new potential framework, I would say the main good news for borrowers who still have the flexibility to do so or who haven't yet taken out a PPP loan is going to be the longer time frame for sure, because that'll just provide more flexibility for potential future shutdown orders if there is a second wave this year. that requires businesses to reduce operations. And then, secondly, I think the change in the percentage for payroll versus non-payroll costs, I think that'll reduce assuming that they get comfortable with the way that new provision is drafted and that percentage does decrease from 75% to something like 60%, then I think, for some businesses that haven't been able to rehire all the way back up or that have lower labor costs but still need support, as it relates to rent payments or utilities, those are like the big picture good things about this, as well as some more flexibility around the inability to rehire employees for reasons that the borrower can't necessarily control, like we mentioned earlier, that if there's some limitation because of safety requirements, I think it creates more of it aligns the PPP a little bit more with the new economic realities, I guess I'd say is the big picture kind of good news. But again, for those borrowers who proceeded under the original set of rules, I think that's not going to provide a lot of consolation. So why don't we, and we can revisit this in the Q&A at the end. There's a few other things I want to get to quickly. So why don't we go to the next slide, and thank you again for that question, Amy. Very quickly, another announcement yesterday that kind of flew under the radar because of the House passing the PPPFA. The SBA and Treasury jointly announced that $10 billion in round 2 PPP funds would be set aside for lending by community development financial institutions, or CDFIs. And this represents an effort in response to, well, I'll just say it without getting into whether it's in response to anything or not. It represents an effort to ensure that program participation in the PPP extends into underbanked communities that CDFIs tend to serve. They tend to work, and they're really required as part of being designated as a CDFI to work on expanding economic opportunities in lower income communities, in particular by providing better access to financial products and services for local residents and businesses in a particular region. And we have some CDFIs here in West Michigan that may be able to benefit from this $10 billion set aside, and as a result, there may be some communities and businesses in the community that haven't participated in PPP yet, but may find it easier to do so as a result of this. So far, CDFIs have originated about $3.2 billion of PPP loans in round 2. And this set aside would, therefore, it's really an additional $6.8 billion on top of the $3.2 billion that CDFIs have already lent out in round 2. So I think that's an important thing for, again, kind of underbanked local businesses, local borrowers. And again, the PPP covers sole proprietors, gig economy workers, not just incorporated businesses. So this may help reach some potential new borrowers. Next slide, please. Okay, pivoting to the latest interim final rules that the SBA issued. We saw on May 15th, it was a couple Fridays ago, 2 weeks ago from today, the SBA released its form of loan forgiveness application, which included quite a few detailed instructions and worksheets. Some of folks on the call may have had an opportunity to have a look at that, and especially those who are getting close to the end of their 8-week period. It provided a lot of guidance implicitly, I guess, because it wasn't a formal rulemaking at that time, but it provided some answers to questions, which we discussed in a prior webinar that we did, I think, last Monday. So we addressed some of that implicit guidance. And then last Friday, kind of heading into the Memorial Day weekend, SBA and Treasury released 2 new interim final rules. The first one of which was really a companion IFR to the application form it had already released. And then the second of which was a more focused on sort of process and procedures for loan forgiveness. And at the time, SBA and Treasury didn't say this, nor have they since, but I think these were broken up into 2 separate IFRs because SBA and Treasury knew that Congress was likely to change some of the loan forgiveness, the substantive loan forgiveness considerations, whereas the process and procedures for for PPP loans were unlikely to be addressed by Congress. So I think the loan forgiveness interim final rule, if and when the new legislation works its way through Congress and is signed into law, that will need to be revisited because many of the concepts would need to be supplemented or changed based on the amended PPP program terms, whereas the process and procedures IFR, as I call it, that probably stands on its own regardless of, at least the currently pending legislation in the House, or the House approved legislation, and what may work its way through the Senate. Why don't we move on to the next slide? So the big picture on the loan forgiveness IFR is that it basically formalizes the guidance and instructions that were already included in the application, which again, we won't go back through all that we discussed in our webinar last week on this topic. There's nothing that really changed the rules or implicit guidance that were included in the application form. There was also just like the application form itself, there was no further guidance on the sort of need certification issue for PPP loans. But having said that, the forgiveness-related IFR did provide some supplemental or additional information or guidance that is helpful. For example, for furloughed employees, it confirmed that the borrower's forgivable payroll costs may include those attributable to employees that aren't being paid during the forgiveness period, that are being paid during the forgiveness period, even though they're not working day-to-day or performing their day-to-day responsibilities or are furloughed. So that was helpful. I think that's consistent with, I know it's consistent with the guidance that, I had been discussing with clients. I think it was generally how the professional and accounting communities, other advisors were viewing the issue, but it was helpful to see that confirmed in the IFR. Next slide, please. Okay, more helpfully, perhaps, the IFR reinforced something that appeared in the application form and seemed to be helpful to borrowers, but wasn't maybe hit squarely on the nose. So the IFR reinforced that both for payroll costs and non-payroll costs, forgiveness would apply to amounts paid or incurred as a general matter during the forgiveness period. And this was prior to the application being released and this IFR coming out. This was a major area of uncertainty where I know a lot of clients and borrowers asking about, do we determine forgivability on an accrual basis or a cash basis? Accounting, those are all great questions. I think the SBA and Treasury basically said, at that time, to provide both more flexibility and just generally make it administratively more feasible to work through the forgiveness applications, perhaps for the lenders. they went ahead and said, okay, if it's paid during the forgiveness period, or if it's sort of incurred or accrued based on work performed in the case of payroll costs during the forgiveness period, both of those will be eligible for forgiveness. So potentially, for example, if you had amounts paid early on in your forgiveness period that related to work performed during the prior payroll period that may have preceded your 8-week loan forgiveness period, you could potentially get more than 8 weeks of payroll costs forgiven. It's unclear how far back in arrears you could have forgiveness on payroll costs still, but it is helpful. I know for a number of borrowers that we have some better understanding that it's paid or incurred concept and not both paid and incurred or just incurred. So this is helpful guidance for borrowers. Another bit of helpful guidance is that the SBA confirmed that hazard pay would be eligible for forgiveness, which again, that was consistent with kind of what we thought would be the case. What we weren't sure about really and were cautious in advising clients about was bonuses. But somewhat surprisingly to me anyway, the IFR did come out and say that bonuses could be included in the forgiveness calculation for payroll costs as well. Both hazard pay and payroll costs related to bonuses would need to be subject to that $100,000 annualized cap on forgivable cash expenses, cash compensation, however. And bonuses was really not defined in any narrow sense. It wasn't, just bonuses for returning to work or just bonuses related to the 8-week period. There were really no exclusions. It didn't say, but you can't include bonuses related to 2019 that haven't been paid yet. It was pretty open-ended. So we'll see if the SBA or Treasury issued any kind of further FAQs or guidance on that topic, but at least for now, the ability to include bonuses and forgivable payroll costs is pretty open-ended, other than the generally applicable $100,000 annualized cap on forgivable cash compensation. Next slide, please. There was some guidance provided in relation to business owners and self-employed individuals, and I don't want to, this could be its own presentation, so I apologize in advance for not getting too far down into the weeds here. This is probably the area where the SBA, one of the areas where the guidance is just most lacking, and the SBA and Treasury have just sort of gotten creative. Maybe it's the most favorable way of describing their approach relative to what the actual statute says. But the IFR states that owner employees, and that is a new turn of phrase that is not defined anywhere in the statute. General partners, self-employed individuals, forgivable payroll costs will be capped at the lesser of, basically about 15% of their 2019 compensation, or $15,385. And then this last bit that's underlined here, in total across all businesses, that was entirely new in the IFR, and it suggests, but is not 100% clear, arguably, that means that if you have an owner employee, for example, of multiple businesses, the amount of forgivable payroll costs for that individual may not be determined for each of the businesses, but rather in the aggregate across all businesses. And that's new in comparison to what was in the application, the forgiveness application form, and I'm not sure how that would get administered based on the current forms that put out by the SBA, other than potentially just later auditing and enforcement of businesses where somebody has multiple ownership interests, I guess. But it does, I guess, from a policy perspective, the idea would be that, for somebody who's an owner or employee they're unable to receive multiple $15,000 forgivable payroll costs from each of their businesses. So we'll see. I think that one is one where we're likely to see more FAQ guidance or have it further addressed in another IFR, because I think the professional attorneys and other accountants and other advisors are not quite sure how to interpret that right now, other than to note it as something to be aware of and to be cautious about. And another thing that was confirmed in the IFR was that no additional forgiveness is available or provided for retirement or health insurance contributions for self-employed individuals, including Schedule C filers and general partners. So, for your other employees who are not employee owners, self-employed, general partners, they are able to receive $15,385 in forgivable cash compensation, and the employer gets forgiveness for other non-cash compensation benefits without the $100,000 cap. So that's different for self-employed individuals, Schedule C filers, and general partners, where they're not getting the forgiveness necessarily for those other categories of non-cash compensation. So as I said, there's a lot to unpack there for those. I think those types of borrowers probably face the biggest challenges and kind of working through their calculations in some senses, just because the guidance isn't as crisp for them. But hopefully we'll have more clarity on that, especially if the forgiveness period is extended and it allows SBA and Treasury to kind of provide some more detail around this. All right, let's keep moving. I know we're running low on time here. Again, the paid or incurred issue here, the IFR reinforced that both for payroll and non-payroll costs, so rent, mortgage, interest, and utilities, the borrowers would be able to obtain forgiveness for both amounts paid or incurred. So there's an example that's expressly included in the IFR that would say, if you have a May utility bill as a PPP borrower, but your forgiveness period doesn't start until June 1st, you are able to obtain forgiveness for that May utility bill as long as it's paid during your forgiveness period. And then similarly, if you have a bill that is a utility bill that is kind of on the tail end of your forgiveness period, but you don't pay it until the regularly scheduled date, which may happen to fall after your forgiveness period, that is forgivable still too, even though it wasn't paid during the period. It was incurred during the payroll, the forgiveness period. And again, it's unclear how far back in arrears this concept could apply, but it did validate the kind of core concept of paid or incurred forgivability. Why don't we go to the next slide? The IFR did restate what the statute itself says about mortgage interest payments not being eligible for forgiveness if they're being prepaid. So there's an explicit statutory exclusion on prepayments of forgivable prepayments of mortgage interest payments under the CARES Act. But the IFR did not address prepayments for payroll costs, rent, or utilities. And that was sort of a conspicuous omission, given that they did address mortgage interest payments, and it would seem to open the door to at least some level of ability to prepay rent and utilities, potentially payroll costs, in order to maximize loan forgiveness. But just a note of caution there is that the IFR didn't expressly say you could do that. It just noted the prohibition as it relates to mortgage interest prepayments without addressing any of the other categories of expenses. I do think that if the forgiveness period is extended beyond 8 weeks, this issue may, for example, if the forgiveness period goes to 24 weeks, this issue may become somewhat academic, given the loan amount would remain the same, but the time period over which you could fund those costs on a forgivable basis would be much longer. And then in terms of full-time equivalent employee calculations, the new IFRs say that FTE calculations should be based on average hours paid for work during relevant calculation periods. So you would look, for example, during your forgiveness period at, what was the average level of hours paid for a particular employee. If it's 40 or above, they count as one full-time equivalent employee. And one thing I do want to note here, it's not in the slide, but this potentially opens up some ability to play catch up with people who were on part-time schedules earlier on in the forgiveness period. If they were, say, getting paid for 20 hours of work for some number of weeks earlier on, but then they end up working overtime, their average hours paid over the forgiveness period, may work out to be closer to 1. So although you're not able to have somebody count for more than one full-time equivalent employee overall, there may be some ability to get a little bit of incremental benefit from any employees who do work overtime, who have their hours reduced earlier on in the forgiveness period, since you'd be averaging out their paid hours during the covered period. Next slide, please. Really quickly here, there's a concept in the guidance, sort of a safe harbor that the Treasury and SBA created for full-time equivalent employees that already existed, related to employees who had been laid off earlier on in the process, and then the employer makes a rehire offer to that employee. And what that safe harbor or that exception said was, if an employee turns down that rehire offer, and that offer was made on basically the same terms as the employee's prior employment terms, and they reject that offer, then the employer is not penalized in their loan forgiveness calculations for that reduction in the full-time equivalent employee. That's a general concept. Like if you try to rehire somebody and they say no, and you document it all correctly, then you won't be penalized. That concept was extended not just to employees who were completely laid off, but also to those who had their working hours reduced, so that if the employer comes back and says, we're ready to bring you back up to 40 hours instead of 20 hours, and the employee says no, I want to say 20 hours for whatever reason, then the employer won't be penalized in their full-time equivalent employee calculations for that situation. But the really new requirement here for both of those situations where the employee rejects either the offer of rehire or the increased hours is that there's a new requirement that the employer, the borrower, has to report those employees who decline those offers to their relevant state unemployment agencies within 30 days of the rejection of the offer. And as before, there must also be, the borrower needs to be careful to retain documentation about the whole process of offering the rehire or the increased hours and then the rejection. And obviously, with this reporting to the state unemployment agency, the general thrust of these requirements is that there's some skewed incentive maybe for employers and employees based on the current unemployment supplement that's out there, and the idea that borrower employers shouldn't get penalized for that as they're trying to restaff or to kind of bring people back up to full-time hours. Next slide, please. All right, and then I think these are the last 2 points on the substance of loan forgiveness. The IFR did confirm that there's not meant to be a double penalty for those borrowers who have a reduction in full-time equivalent employees that then results in a reduction in overall compensation. There have been some concern that that would have a compounding effect on the reduction in loan forgiveness because of the way the CARES Act works. And it wasn't entirely clear from the language in the statute whether the loan forgiveness amount would be reduced both for the reduction in FTEs and then as a result in the reduction of compensation. The IFR clarified that that was not the case. The SBA considered it with Treasury. They decided no, it should only be the portion of the decline in employee salary and wages that is not attributable to an FTE reduction. So as an example, if you maintained hourly comp, hourly wages for hourly employees, for example, but you decrease their hours by 50%, you're not going to get, you're only going to experience the FTE reduction for your loan forgiveness calculations because you kept their hourly wage steady. It would only be if you reduce their hourly wage by more than 25% that you would potentially have that kind of double reduction in your loan forgiveness. And then lastly, on the documentation front, the IFR restates, again, the importance, really the requirement to maintain basically your entire PPP loan support file for 6 years after full loan forgiveness or repayment. That was included in the forgiveness application itself, but reinforced in the IFR. So how do we keep going? We're running low on time. Well, I think we'll go over, and I know that this will be available for replay on our website with the webinar slides. So if you have to drop, the rest of this will be available for review or rewatching later, I think, on our YouTube channel. So we're going to keep going through the second IFR here, which relates to the process and procedures for loan forgiveness. And it starts to bleed now into the areas where Amy and her team are kind of more focused on the potential for later review by the SBA or other agencies and how the process for forgiveness and review unfolds. And so one of the first things they say in the process IFR is that for a PPP loan of any size, SBA may undertake a review at any time in SBA's discretion, which is obviously extremely open-ended. Some of the examples of things that they say that they are able to review are eligibility, loan amounts, use of loan proceeds, loan forgiveness amounts. So basically everything related to participation in the PPP. And there was a reference to assessing this based on rules and guidance available at the time of the loan application, which may be helpful for some borrowers. But in general, this is, I'd be curious, Amy, on your take on this, but basically saying that we retain the right to review anything and everything whenever we want, including through our Inspector General.
Right. Yeah, this language is something you quickly pick up on when you look at the interim final rule. And, you know, as you just mentioned, it is encouraging to see a commitment to applying the rules and guidance that were available at the time of the borrower's loan application, given that nobody was able to, you know, get out a crystal ball and predict the changes in those in the guidance that would unfold after a loan application. So that, you know, the suggestions that came up in some of the FAQs that there would be a retroactive application of guidance, you know, that seemed rather unfair to all of us who've been following this. And so, you know, I think it's one of the many things we can't consider ironclad about about the PPP program and these issues surrounding procedure and investigation of loans. But I am glad to see the commitment nonetheless that rules and guidance will be applied as they, as they were known to the borrower at the time that the borrower applied. But the one thing that this, the immediate question that this raises is, does the SBA intend to review loans under $2 million, on things, on the needs certification in particular, right? Because the SBA's FAQs thus far have suggested that specific to that need certification, loans under $2 million are deemed to have been made in good faith. And I don't see this interim final rule as really trying to reconcile that statement with this commitment to review loans of any size at any time. So there is a little bit of friction there, and I think it just underscores how important it is that businesses who receive these loans keep, thorough documentation of their eligibility and the other reasons or the other issues surrounding their loan application, so that they are ready if the SBA does decide to take a more scrutinizing look at their eligibility, their use of the proceeds, their forgiveness application, things like that.
Right. And I do want to keep moving because I know we're over time, but one thing that I want to note for how this could play out is that, and Amy, you shared this story, this reporting with our internal PPP team today about reviews kind of on a bank level, right? And then seeing if there are patterns within a particular borrower group served by a specific bank that then cause SBA to focus more in on that bank's borrowers of any size. And so some of this may be outside of the borrower's control, because it could be that their lender, had some practices that caused it to become subject to more scrutiny, and then the audit or review becomes more granular down to the borrower level. So there's some of it is just going to be outside of the borrower's control, obviously. Why don't we keep moving? I'll go through this quickly, but the upshot here is that there will be some ability for borrowers to provide information and additional responses if the SBA does have questions about a forgiveness application. And there will be some kind of a loan forgiveness appeal process that the SBA and Treasury say will be outlined in yet another interim final rule. So there will be an ability to appeal an adverse determination, but we don't know exactly what that will look like yet. And then on the calculations that a borrower provides to its lender, the lender is required to perform some kind of good faith review of the loan forgiveness application and key calculations. But ultimately, responsibility for calculations will remain with the borrower. I think the lenders will be heavily incentivized to make sure that the loan forgiveness applications they present are presented in a way that the borrower remains eligible. The guidance put out in this IFR says that lenders will have to repay or will not be entitled to get their origination fees for PPP loans if the borrower was ineligible. So I think you'll see lenders working with borrowers to make sure that the T's are crossed and I's are dotted so that the lender doesn't risk losing their origination fee on the PPP loan. Next slide, please. And then some timing issues here. Basically, the lender will have 60 days after the borrower's loan forgiveness application goes in to make a decision, either rejecting forgiveness, providing partial forgiveness, entire forgiveness. One of the determinations could be basically that the loan forgiveness application remains under review by the SBA, and that would just basically put the whole process on pause. And the SBA would have that, there's a 90-day period between when the forgiveness application determination is made and when the SBA has to remit the forgiveness amount to the bank. And they can use that, the SBA can use that period to review the loan file if they choose to and kind of put the process on pause. If a lender does make an adverse determination with regard to a borrower, they would have to notify both the SBA and the borrower, provide their rationale for the decision, and then the borrower would, again, there's sort of an appeals process here. They'd be able to request that the SBA review their lender's determination about non-forgivability or non-eligibility for forgiveness, as long as they do that within 30 days after they get the notice from their lender. Next slide, please. And we touched on this already, but the SBA has got this 90-day period to review once they get the lender's sort of preliminary determination about forgiveness. If the SBA does initiate review, they will notify the lender. The lender in turn must notify the borrower, and the lender may be required, and probably will be required to some degree, to transmit the borrower's loan file and information to SBA as they're reviewing the loan forgiveness application. So importantly, borrowers should assume that anything they provide to their banks, their lenders, may ultimately be provided to SBA as part of this review process. So that's just another kind of reason to be mindful of kind of the record you create, both internally and what's submitted to the bank, because your bank may be required to transmit that information to SBA during the forgiveness process. Next slide, please. Okay, so conclusions. The kind of doubling back to where we started, the PPP Flexibility Act or a similar bill would really be a game changer for, especially for new or relatively recent PPP borrowers, by adjusting some of the program rules for the kind of new reality, the new economy that we're in now. However, as we've touched on in a number of places, it does underscore this just constantly shifting rules of the road for PPP participants. That's got to be, I know, extremely aggravating, especially for the earlier borrowers who made plans based on an original 8-week period, and now, that's thrown up in the air, and they're maybe not quite sure how some of the new rules might be helpful to them or not. Again, the SBA is going to need to do a lot of work revisiting all their prior guidance and forms should this new bill or something similar coming out of the Senate through reconciliation become law. And so on the whole, while the latest guidance is definitely helpful on the margins, there's surely more to come, just based on the remaining open questions that would have been there anyway, even if Congress didn't do anything, but also probably more meaningfully coming out of any congressional action that approves statutory amendments or modifications to the PPP. And with all this kind of shifting landscape, I think it underscores, at least from the lawyer's perspective, which is what we bring, is that compliance with, good faith compliance, doing the best you can, given the evolving program rules, is still critical. There's nothing in the new law, the new rulemaking, that really lessens the burden from a compliance perspective on the key issues related to PPP participation and creating a good audit record in case you 6 years from now have somebody from SBA, potentially from a different administration knocking on your door about your use of PPP funds. So with that, I'm going to turn it over to Amy for a bit. I see we've got some questions in the Q&A. I'm going to answer a few of those in typing. For some of the ones that may be of interest to the broader group, I'll raise those so that we can talk about them with those who are remaining on the line. Amy?
Thanks, Eric. I will keep this short. We, as Eric has made clear over the course of this hour, a little bit more than an hour, it is indeed a shifting landscape for PPP borrowers. And, we saw this getting more and more complicated for our clients and for businesses in our community, and decided, in keeping with a phrase we've been throwing around, an ounce of prevention is worth a pound of cure, which Ben Franklin said many, many years ago before PPP. We decided to assemble a team of, about 15 lawyers strong who are focused on these changing rules of the road for the PPP program, in the hope that we can help our clients increase their confidence in their compliance efforts and be audit ready, so to speak. So the team, as Eric alluded to earlier in the webinar, is a group of business or transactional lawyers like Eric who are steeped in this law and looking sort of forward-looking at the issues that our clients are facing, our businesses in the community are facing as they deal with their applications under the PPP program. And then also the team has some litigators whose focus includes government investigation experience. With that team, our goal in this program, this audit and compliance readiness program, is to offer businesses a strategic solution, one where we're working potentially with your other advisors, like your accountants, to gather and organize the relevant data that speaks to your need for the loan, your proper use of the loan proceeds, have you in a position where you've got a sort of binder, so to speak, that shows your overarching compliance with the rules of PPP. And then secondly, to help you deal with any resulting inquiry or investigation related to your application under the PPP or your use of PPP funds. We really do see a benefit in having that contemporaneous record now. It will, I have no doubt, save headaches later down the road if, as Eric mentioned, 6 years possibly from now, you are having to answer questions about your application for the loan, your use of the proceeds, whether your forgiveness application included accurate information at the time. And there's truly a benefit to making the record contemporaneously too, because there's a sense that the information assembled right now is going to be more reliable than the information you sort of have to pull together when you're backpedaling, 1, 2, 6 years down the road. So we've got a team that's, ready and willing to help you if you're interested in making sure you are audit ready, so to speak. And you'll see on the screen now that we've got a flat fee sliding scale based on the amount of your loan, with the maximum fee of $5,000 for loans that are over $2 million. And that's the ounce of prevention, as the Ben Franklin quote goes, that we hope will save you some stress as you move forward and get your business, resuming to full capacity in the years to come.
Yeah, thank you very much, Amy. That's helpful, hopefully, for clients thinking about making that type of compliance investment. I do want to pivot to some of the Q&A, which I've typed answers to some of the questions that I'm not sure will be as broadly applicable to the group. But there are some in here that I think will be helpful to address live, and a couple of which have come in from different listeners, and appreciate the good questions. One category of question is, if the 8-week period gets extended to 24 weeks, will employers be required to maintain payroll levels for all 24 weeks? Would this not be far higher than the money received? So that's a great question, and I didn't include this in the slides. I probably should have, but there is an option for borrowers to retain, just keep the existing 8-week forgiveness period should they want to under the Payroll Protection Flexibility Act. So, if the borrower has made their plans based on the 8-week forgiveness period, they can choose to keep that period rather than have kind of the 24-week period thrust upon them. So if you're better off, just kind of because you've made your plans based on the 8-week period and you've got a strategy and it's playing out, you can keep that, should that provision remain in the ultimate legislation that gets passed by Congress. So that's a very good question, and I think it answers similar question that came up from one or two other people. Other questions, I'm just kind of going through this real time. I'll stay on. I think I can stay on until about 9:30. Amy, if you need to leave for any reason, you're obviously, I welcome you to stay, but I'm going to just kind of hang on a little longer for those who want to go through questions as long as I can. Another question, do you foresee an updated loan forgiveness application coming out in the near future? I don't see that coming out in the near future, but should Congress pass this legislation or something that looks like it, they will definitely need to update the loan forgiveness application just because it includes so many of the concepts that will be modified. And it'll be more complicated, right? Because for one, the reason I just stated, which is that a borrower could choose to keep their original 8-week period, or they could choose to use the longer forgiveness period. So that, I don't think that's going to happen in the near term. I think SBA and Treasury will take some time because it's going to need to be more complicated, unfortunately. Here's a question. At what point is any forgiveness amount determined final? Is it after the 90-day SBA review period? I don't want to move the loan forgiveness income, pay it out to shareholders only to have the forgiveness revoked. That's a great question, and I think the most direct answer I could give on that is that we don't really know, to be honest. There's nothing in the statute that says when this determination is final. I think from a practical perspective, you can consider your amount to be as close to final as possible once, especially if you go through an SBA, you've gone through an SBA review period because of correspondence you've gotten from your bank about the SBA taking time to review your file or asking for documents. If you go through that process and then the SBA remits the forgiveness amount to your bank, I think that's probably, based on what we know now, that's close to a sort of final determination as one could hope for. But there is that language in the IFR that says the SBA can undertake a review at any time for any reason. So, it's a terrific question because that language does suggest that this is just an open-ended ability to review forgiveness issues. And I'm sure Amy and her team will probably end up dealing with some version of that for borrowers, unfortunately, even past that 90-day period. But just from a practical perspective, I think if you engage in some back and forth with the SBA and your lender during that 90-day period and then you get a forgiveness determination. That's probably about as close to final as we could say you're going to get during based on the current guidance. Amy, I don't know if you're still on the line, if you have other thoughts on that, but my view is that the IFRs make it virtually impossible to have 100% certainty on forgiveness until you're outside of that 6-year period, if not longer.
Yeah, unfortunately, I agree with your analysis on this, Eric. And, maybe more clarity comes as things continue to evolve. But I think the 6-year outlook is, from a documentation retention perspective, important to keep in mind. And, there's some comfort to be gained when, as you mentioned, that there's, they've undertaken a review and nonetheless made the payment, at the end of the 90-day period.
Right. Okay, so there's a question. How do you see this working out if our FTE was to the pre-COVID level before June 30th, but we are well below by December 31st? I think this kind of goes back to the idea that a borrower could keep their 8-week forgiveness period if they elected to, but they're just to put a finer point on it, you wouldn't be able to keep the 8-week period for certain things, but not other aspects of the program. And my read of the bill that was passed by the House is that it did not get into kind of the granularity of making this distinction between the 8-week forgiveness period and how that relates to a June 30th date for kind of the safe harbor rehiring. It's a very good question. I think, and I would hope that the SBA and Treasury would interpret the new legislation, if it's passed in the form that is something similar to what the House just passed yesterday, that if you're a borrower who chooses to keep the 8-week period and you're an early borrower, that you would hopefully still get the benefit if you opted to use that 8-week period of using that June 30th date as your kind of benchmark for having rehired or reinstituted compensation, because borrowers who are earlier borrowers in particular have been planning their staffing and restaffing on that premise. So while it's not entirely clear, not really clear at all in my read of the House bill, I think that would be my hope, is that borrowers who do opt in to keep that 8-week forgiveness period would also be able to continue to use that June 30th rehire date if they did so. But say that with the caveat that I think that might, unless the legislation were changed, I think that would require guidance and interpretation from Treasury and SBA. So we'll stay on for about 5 or 7 more minutes here to address some more questions for those who are still on the line. Some of these are I'm going to try to focus on the ones that have broader applicability to the most borrowers. Can you clarify the possible need certification requirement as it pertains to the forgivable portion of the PPP loans? The need certification requirement is sort of a threshold issue for participating in the PPP generally. So if you had a decision tree or a process tree for the PPP, the program as a whole, the need certification would be pretty early on in the decision tree process. You'd have, before that, you'd have, are you even an eligible small business that can participate in the PPP? And then you'd have, okay, do you meet the need certification criteria? If the answer ends up being no for that, for whatever reason, and the SBA has put out an FAQ saying that they are not going to second guess the need certifications for borrowers with loans below $2 million. But if you're above $2 million and you have your need certification reviewed, that's going to be presumably disqualifying across the board, and it will not. I don't think you even get to the kind of the forgivable portion of your PPP loan. I think, based on what is currently out there, you would just be ineligible for any forgiveness, and the SBA would request that or insist that you repay your loan. Hopefully there would be no other penalties beyond that, assuming you acted in good faith throughout the process. But hopefully that answers your question. If your need certification is determined by the SBA to be not valid, then there will be no forgiveness, unless you fight that determination by the SBA through the appeals process and have it, overturned or reach some other kind of settlement with the SBA based on your circumstances. Amy, I don't know if you have a different view or take on that one, but I view that as sort of a threshold consideration.
Yep, I agree.
Okay, we'll do one or two more questions here, and I apologize that we won't be able to get to all of these questions. Okay, there's another question here. Is it either 8 weeks or possibly 24 weeks? Could we do it for 10 weeks if it gets changed to 24 weeks? The answer to that is no, at least in the current bill. And I don't think it would be different based on kind of the reporting of what the Senate is looking at, is that, it'll be either whatever period, 24 weeks. The Senate has 16 weeks in their bill. Maybe it gets compromised at 20, but whatever the number of forgiveness weeks ends up being in the congressionally passed changes, it'll be that period. And there is this ability to retain your 8-week period under the House bill, but I don't think it's going to be able to be, you choose some other period of time between 8 weeks and whatever longer period is included in the final legislation. We will do one more, and I'm going to try to, again, choose a question here that has broader applicability. Can we request loan forgiveness once we fully spend our PPP loan proceeds, even if the spend period is not over? If possible, I'd like to have the loan forgiveness decision prior to 12. Yeah, I think the answer to that is yes. Once your period is over, or even if it's not over yet, I believe there's really just not a lot of guidance. There's nothing in the statute that dictates or provides instruction about when you should or must or can go in to seek forgiveness. But in thinking this through, I guess whatever forgiveness period you do choose, if you choose to retain the 8-week period, I think you will need to wait out that 8-week period. If you use the longer period, you're going to need to wait out the longer period, whether it's 24 weeks or something else, because the forgiveness determination will be based on, in some part, your what levels of full-time equivalent employees you retain during that either 8-week or 24-week period. So you are going to have to wait out that whatever week period ultimately ends up applying to your situation, because your forgiveness amount is going to depend on your comp and staffing levels during that period. So no, you won't be able to go in early unless, by early you mean just sticking with your 8-week period and then going in for forgiveness based on that 8-week period. Otherwise, you're going to have to see through, kind of whatever forgiveness period you ultimately elect to use, just because some of the forgiveness calculations depend on what you do with staffing and compensation during that same period. So with that, I'm sorry we couldn't get to all these questions. Certainly, you should feel free to follow up with me or Amy or another Miller Johnson attorney you have a contact with. If you have further questions related to this topic. And we definitely want to thank everybody for joining the webinar today. We find it really engaging to get the questions and feedback from clients and other listeners, viewers of the webinars, because it helps us understand better what issues are on your minds and then helps us provide better client service. So I appreciate it. Amy, do you have any final thoughts before we sign off here?
I'll just echo our thanks that, listeners are participating and bringing good questions our way so that we can better serve all of you. And, if you do end up finding that compliance preparedness program of interest, please feel free to reach out to Eric or me or any of your Miller Johnson contacts, and we'll talk through with you the possibility of using that program to give you a little bit more peace of mind as you move forward with your PPP loan and your use of the loan for for payroll and other important expenses of your business.
Great. Well, thank you very much, Amy, and thank you for all the participants who attended today. I hope you have a great Friday, a good weekend, and you're staying healthy and getting your hopefully your business back up and running safely and efficiently in the weeks preceding this or in the weeks ahead. So thank you. Take care, and hopefully we'll be able to talk again soon. Goodbye.